three, let's go!
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nofarisha Binti Azami. We would like to present employees benefit under MFRS 119. Okay, first for the definition. All forms of consideration given by an entity in exchange for service rendered by employees or for the termination of employment. Consideration can be reward in monetary or non-monetary. Immediate reward include monthly salaries or wages. Delayed reward can be received upon termination of employment or upon completion of predetermined years of service include pension. For overall principle, an entity should recognize A liability when an employee has provided services in exchange for employee benefit to be paid in the future, such as pension pays. B, an expense when the entity consumes the economic benefit arising for service provided by an employee exchange for employee benefit, such as salary. Okay, for the main issue, recognition of various forms of employee benefit, measurement of the expense and related liability together with the funding requirement if the benefit plans are funded. Next, valuation of plan asset to assess whether they are sufficient to cover the related liability. And last but not least, presentation of the employee benefit in the financial statement means disclosure in the financial statement.
Hi, Assalamualaikum. My name is Anis Nazia binti Osman. So, there are 4 types of employee benefits, which are short-term employee benefits, post-employment benefits, long-term employee benefits, and termination benefits. Firstly, short-term employee benefits is the benefit that is to be settled wholly within 12 months after the end of the period in which the employees render the related service. Let's say, if an entity's accounting period ends on 31st December 2019, then the short-term employee benefits has to be settled within 1st January 2020 until 31st December 2020. There are 4 categories covered under short-term employee benefits. First, wages, salaries and so. Second, short-term compensated absence such as paid annual leave and sick leave. Third, profit sharing and bonus payable. And fourth, non-monetary benefits for current employees such as medical care, housing, cars, and free or subsidized goods or services. So here is the recognition for short-term employee benefits. An entity shall recognize the undiscounted amount of short-term employee benefits that is expected to be paid as a liability because it is an accrued expenses after deducting any amount that is already paid. If the amount already paid exceeds the undiscounted amount, then the excess shall be treated as an asset because it is a prepaid expenses. The entity also shall recognize the short-term employee benefits as an expense unless there are another MFRS that requires the benefits to be included in the cost of an asset, such as MFRS 102 inventories and MFRS 116 PPE. The first category under short-term employee benefits is wages and salaries. The entity shall recognize wages and salaries as an expense unless they are capitalized in asset. If the entity has any amount unpaid to the employee, it shall be treated as a liability. The second category under short-term employee benefits is paid absence. Paid absence is when the entity still has to pay the employee even though the employee absence for various reasons such as sickness, maternity or paternity, holidays, jury service or military service. There are 2 types of entitlement of paid absence, which are accumulating and non-accumulating. Accumulating paid absence is when the employees render service that increases their entitlement to future paid absence. In other words, employees are allowed to not fully use their paid leave to increase entitlement in future years. Accumulating paid absence can be carried forward if the current period's entitlement is not fully used. The accounting treatment is the entity shall recognize it as a liability For the amount payable to the employees, there are two types under accumulating paid absence, which are vesting and non-vesting. Vesting is when the employees are entitled for a cash payment for the unused entitlement of leave. For example, Mulia Berhad's employees are entitled to 30 days of paid leave for each calendar year. The salary for each employee is RM200 per day. Employee C has 15 days unused leave from previous year. Thus, the accrued liability brought forward is RM3000, which is 15 days times with RM200. Meanwhile, non-vesting is when the employees are not entitled to cash payment for the unused entitlement of leave. For example, employee C has 15 days of unused entitlement of leave from previous year. Thus, the unused leave will be carried forward to the future years, even though the entity does not have to pay any cash payment to the employees, but the obligation is still to be recognized. Next, non-accumulating paid absence is when the absence occurs. It cannot be carried forward to future years if the current year's entitlement is not fully used. Employees also are not entitled to cash payment for the unused entitlement of leave. The accounting treatment is the entity shall recognize it as a liability or expense only when the absence occurs. For example, Halia Berhad has 100 employees who are each entitled to paid sick leave for a maximum period of 1 month. Unused sick leave cannot be carried forward to future years. During the year ended 31st December 2019, employee W met with an accident and went on leave for 2 months. His monthly salary is RM3000. For compassionate reasons, the company continues to pay the employee his full 2-month salary. Explain how Halia Berhad shall account for the sick leave for the employee. The solution is the employee's 2-month salary is to be recognized as an expense when it is paid, although the employee is on sick leave for this period. The third category under short-term employee benefits is profit sharing and bonus plan. Under profit sharing, employees receive a share of the profit only if they remain with the entity for a specified period. As for bonus plan, an entity may have no legal obligation to pay a bonus. However, in some cases, an entity has a practice of paying bonuses. Thus, an entity may have a constructive obligation to pay profit sharing and bonus to the employees. If these payments are not expected to be paid within 12 months after the end of the accounting period, then it shall be classified under other long-term employee benefits. As for recognition, an entity shall recognize the expected cost of profit sharing and bonus payment only when first, the entity has a present legal or constructive obligation to make such payments as a result of past events, and second, a reliable estimate of the obligation can be made. For the accounting treatment, the profit sharing and bonus plans are to be recognized as an expense and a liability when the entity has no other alternative but to make payment. Next, how can an entity measure a reliable estimate? A reliable estimate of constructive obligation can only be made when these 3 conditions are met. For example, PRUQ Berhad decided to pay bonus to the employees who served throughout the year. The expected bonus to be paid is 5% if no employee leaves the entity. However, the employees are expected to leave. Therefore, the payment will be reduced to 3.5%. The solution is, at the end of the year, PRUQ Berhad will recognize an expense and a liability of 3.5% of the profits. Assuming the profit is RM4 million, therefore the bonus is RM140,000. The journal entry is debit expenses, which is other employee benefits, and credit liability for accrued employee benefit. Lastly, for disclosure, MFRS 119 does not require any specific disclosure about short-term employee benefit, but other MFRS may require disclosure, such as MFRS 124 and MFRS 101. Thank you from me.
Hi, Akila here to explain to you the second type of employee benefits, which is post-employment benefits. It is a retirement payable income after the employment. It can be either short-term or long-term, such as retirement benefits, which consist of pension and lump sum payments retirement, and other post-employment benefits like medical care and life insurance. This plan can be explained and can be classified into two, which are DCP and DPP. DCP is defined contribution plan, while DPP is defined benefit plan. Okay, the next slide is for the classification of the plan. It is formal or informal arrangement by entity provides benefits for one or more employees. You can refer to Para 8 MFRS 119. Okay, let's take a look at this diagram. According to Dales, we can differentiate between DCP and DPP. The parties is the same, which are the company, pension plan, and also the employees. But the contribution is different, where for DCP, the company will contribute fixed amount defined contribution to the pension plan, and it will flows to the employees by the pension plan in the future, okay, to the amount of contribution plus any gain. Okay, for DBP, company contribution according to the amounts needed, and pension plan will give to the employee according to the predetermined benefits. This slide explains about the difference between DCP and DPP in the context of multi-employer, state and insured plans. Under MFRS 119 Para 8, it describes MEP plan that grouped the asset from various companies that are not under the same control to provide benefits to their employees from more company, and it is not determined by their employment. While Para 32 MFRS 119 say that company needs to classify MEP under DCP or DBP. Okay, if it is a DBP, entity shall account for its proportionate share of the defined benefit obligation in the same way as for any other DBP and disclose some information in MFRS. But when there is insufficient information to use the defined benefit accounting, the entity shall treat it as DCP, and it should disclose the fact that the plan is DPP and gives reason why there is insufficient information. For example, in Para 35 subsection B, MFRS 119 explain where the employees' benefits are determined by the length of their service, and participating entities have no realistic means of withdrawing from the plan without paying a contribution for the benefits earned by the employees. Now we move to the second plan, which estate plan. Estate plan means established by legislation by the national or local government or another body. Most are DCP, since the entity has no legal or constructive obligation to pay benefits due to employees, but there are some are DPP, so the entity shall account for the plan same way as MEP. The last one under distinction of DPP and DCP is insured plan. It refers to insurance premiums shall treat as DCP, but if the company has legal or constructive obligation to either pay the employees' benefit directly when they fall due or pay further amounts if the insurer does not pay. Either one of these two cases, the entity shall treat it as DBP. Under DCP, what is DCP? Defined contribution plan. Explain that entity legal obligation limited the amount that agrees to contribute to fund. It means that the company, entity is actually a company that obliged to pay the amount that agrees to contribute to the fund. And fund, let's say, is EPF.
Okay, I'm going to simplify the second and third points, which it means that when the fund, for example EPF, does not hold sufficient asset to pay employees' benefits, then the EPF and also the employer does not have legal obligation to pay further amount. Okay, so the employers will get the amount of contribution plus any capital gain arise from the contribution. This journal entry refers to the company overview. Okay. To recognize the contribution payable is classified as an expenses. When contribution is paid, it is recognized as an expense in the year it is paid, or as an expense and liability if there is any accrued expenses. When contribution is due but unpaid, it is recognized as an expense and a liability when it becomes due, or an asset when there is prepaid expenses. When a contribution is overpaid, the amount overpaid is treated as an asset, which is prepayment in the year it is paid. Next slide is on disclosure. Under MFRS 119, okay, the amount must recognize as an expense, while MFRS 124 disclose the information contribution. And also, I've included the summary here for you to know there is 3 situations to record the post-employees benefits, either debit expenses or debit asset and credit liability or credit asset. The last slide is for the long-term benefit plan under profit and loss. And this slide will be explained more details by Nadia Mahira. Thank you.
I am Nadia Mahira binti Zakwan, and I will continue the presentation with defined benefit plan. Defined benefit plan is a post-employment benefit other than DCP. The benefits are defined in advance and the employer contributes to the plan over the period of employment to meet the defined benefits at retirement. The use of estimate based on actual assumptions is substantially involved considering employees' earnings and years of service. The obligations are measured on discounted basis and they may be settled many years after the employees render the related service. It can be funded or unfunded or wholly or partly funded by the entity. When the plan is funded, either wholly or partly, the employer is legally bound by ultimate amount that will be payable to retiring employees and thus need to ensure sufficient contribution is made to meet commitment at settlement date. Even if an entity has no legal obligation, it may still have constructive obligations. An entity shall account not only for its legal obligation under the formal terms of a defined benefit plan, but also for any constructive obligation that arises from the entity's informal practices. Informal practices give rise to a constructive obligation where the entity has no realistic alternative but to pay employee benefits. For example, a change in the entity's informal would cause unacceptable damage to its relationship with employees. Presentation of defined benefit plan is under 3 categories. In statement of financial positions include defined benefit liability or asset. Furthermore, in statement of profit or loss, in profit and loss include service costs and net interest on liability or asset. However, in other comprehensive incomes include remeasurement costs. Furthermore, in notes to financial statements include other disclosures. Defined benefit liability or asset in statement of financial position is calculated by comparing the present value of defined benefit obligation and the fair value of the plan asset. If the defined benefit obligation is higher than the plan asset, it will be a liability, and if it is the other way around, it will be an asset. MFRS 119 does not specify whether an entity shall distinguish the defined benefit liability or asset into current or non-current portions. It may be present in accordance with MFRS 101. Fair value of asset may exceed the present value, whereby the disclosure of defined benefit asset is subject to paragraph 64 of MFRS 119. Therefore, it needs to be compared with the asset ceiling. You can see an example of defined benefit plan in Tan Notong textbook, page 692, example 5. XYZ Berhad operates a defined benefit plan for its employees. As at 31st December 2019, the present value of the defined benefit obligation is Rm 50 million. On this date, the fair market value of the plan asset, which consists mainly of equity investments, bonds, and other fixed income securities, is Rm 48.5 million. Therefore, the net liability of the defined benefit plan recognized in Statement of Financial Position is 1.5 million. As I mentioned in the previous slide, if you get a defined benefit asset, you will have to compare it with the asset ceiling. Asset ceiling is the present value of any future economic benefits available in the form of refunds from the plan or the reduction in future contributions to the plan. The lower of the two values is recognized as the retirement benefit asset in financial statements. When asset ceiling is lower than the surplus of the plan asset over the defined benefit obligation, asset ceiling is recognized as the net defined benefit asset in financial statements. Thus, the surplus need to be written down to the asset ceiling. This is the effect of the asset ceiling. A portion of the effect of the asset ceiling is recognized in statement of profit or loss as part of net interest on net defined liability or asset, and the remaining amount is recognized in other comprehensive income as part of remeasurement costs. The effect of asset ceiling can be seen in the example 6 Tan Leong Tong textbook page 693. Suppose in example 5, the fair value of the plan asset as at 31st December 2019 is Rm 56 million. Also assume that the present value of reduction in future contribution to the plan is estimated at Rm 4 million. Therefore, you can be seen that the net defined benefit asset is at 6 million at first. However, because there is a difference with the asset ceiling amounting to 2 million, therefore the surplus has to be adjusted, and the 2 million is recognized in statement of profit or loss and other comprehensive income, and the amount recognized in statement of financial position is only 4 million ringgit. And now we move on to the defined benefit cost in profit or loss. There are two costs that have to be calculated, which are the net interest on the defined benefit liability or asset and also the service cost. The formula for the net interest on the defined benefit liability or asset is calculated by fair value of defined benefit obligation at start of reporting period less a fair value of planned asset at start of reporting period, and once you get the amount, you have to multiply it with the discount rate and add with the interest expense on effect of asset ceiling, and you will get the net interest on net defined benefit liability or asset. And as for service cost, it can be calculated by adding the current service cost with past service cost, which includes plan amendments, loss or gain on curtailments, and also loss or gain on settlement, together with the net interest on net defined benefit or liability, which you will get the defined benefit cost or income recognized in profit or loss depending on whether or not it is a negative amount or a positive amount. MFRS 119 does not prescribe how defined benefit costs are to be disclosed in profit and loss. However, as per MFRS 101, Presentation of Financial Statements, entity may disclose the net interest on the defined benefit liability or asset as part of finance costs, or the whole expense as part of employment benefit expense under operating expense. Furthermore, in other comprehensive income, we will have to calculate the remeasurement cost. Some of the details of the cost in the formula are to be explained in the next slide, which include the actual gain or loss from defined benefit obligation, the return on planned assets, and effects of asset ceiling. And you will get the retirement benefit remeasurement expense or gain that you will have to recognize in other comprehensive income. Okay, the actual gain or loss for defined benefit obligation is calculated by adding the fair value at the beginning of the year together with the current service costs, investment costs, which include legal and managerial fees incurred on the investment, and imputed interest costs, and past service costs that incurred during the year, and also the benefit paid. And you compare it with the fair value at the end of the year, you will get actual gain or loss. Return from plan asset can be calculated by adding the expected return together with the actual gain or loss. Expected return includes interest, dividend, and other revenues estimated to derive from the plan asset, realized and unrealized gain or losses on the plan assets, less any cost of administering the plan, and less any tax payable by the plan. And as for the actual gain or loss, it can be calculated by adding the fair value at the beginning of the year, contribution received, expected return on plan asset, payments for funding, and less the benefit paid, and the amount is to be compared with the fair value at the end of the year. You will get the actual gain or loss. A portion of the actual return will be recognized in profit and loss as part of the net interest on the defined benefit liability or asset, and as for the remaining amount, it will be recognized in other comprehensive income as part of the remeasurement cost. When one entity has more than one DBP, it is allowed to offset the defined benefit liability of one plan against a defined benefit asset of another plan. But it can only happen when it has legal enforceable right to use the surplus in one plan to settle obligations in another plan, and it intends either to settle the obligations on a net basis or to realize the surplus in one plan and settle obligations in the other plan simultaneously. The third type of employees' benefit is other long-term benefit. Other long-term benefits include long-term paid absence, such as long service or sabbatical service, jubilee or other long service benefit, long-term disability benefit, profit sharing and bonuses, deferred remuneration paid 12 months or more after the end of the period, not due to be settled within 12 months after end of employment. In calculating other long-term benefits, present value of obligations and fair value of plan asset at reporting date should be determined, and it can be calculated by adding the current service cost together with the past service cost and net interest on net defined liability and remeasurement costs. Entity shall then recognize the net total of the following amount in profit or loss for the period.
And now we move to termination benefit. Termination benefit is different because it is result from entity's decision to terminate employment, employee's decision to accept an entity's offer of the benefit in exchange for termination of employment. Voluntary resignation or mandatory retirement is excluded since these are post-employment benefits. Okay, for the recognition, an entity shall recognize a liability and expense for the termination benefit at earlier of the following dates. A. When the entity can no longer withdraw the offer of those benefits, means it is liability. And B. When the entity recognize cost for a restructuring that is within the scope MFRS 137 and involve payment of the termination benefit, means it is expenses. Now we move to measurement. An entity shall measure termination benefit on initial recognition and recognize the subsequent changes. If enhancement to post-employment benefit depending on the nature of employment benefit, the entity shall apply the requirement for post-employment benefit. Otherwise, if the termination benefit are expected falls before the 12 months after reporting period, then it will be recognized short-term employees benefit. If the termination benefit are expected to be falls after 12 months after the reporting period, then it will be recognized other long-term employees benefit. However, if the benefits for terminations of employment due to employee resigns voluntarily, means willingly, lower than the benefit at request of the entity, means employer, for him to resign, therefore the difference between these two amounts is the termination benefit. Okay, for the disclosure, MFRS 119 does not require specific disclosure about termination benefit. However, other MFRS may require the disclosure, such as MFRS 101, Purpose of Employee Benefit Expenses, and MFRS 124, Purpose of Key Management Personnel. Okay, for clearer explanation, this is example that adapted under MFRS 119. In this case, the entity decided to close down and there are 120 employees. Each employee who remains in the service until the factory is closed will receive 30,000, and each employee who leaves the factory before the factory is closed will receive 10,000. At the time of the announcing plan, the entity expects 20 of the employees will leave before the factory closes. For the solution, the entity will have to pay 10,000 for terminating the employment of the employee regardless of when they leave the factory. As such, the entity will recognize a termination benefit liability of 1.2 million at the earlier of when the plan is announced and when they recognize the restructuring costs associated with the closure of the factory. It refers to recognition as I explained before. Okay, the difference between 10,000 for earlier departure and 30,000 for leaving at the end of the 10 months in exchange for service rendered during the period. Therefore, the entity should account the 2 million as short-term employees benefit since it less than 12 months. Each month over the 10-month period, the entity will recognize 20,000 as short-term employees benefit with corresponding increase the carrying amount of the liability, means current liability. Okay, in conclusion, the 10,000 is recognized as expense for all employees, but 20,000 to the remaining 100 employee recognized as liability as will incur when the company close. Thank you.